Government bonds and corporate bonds. A bond is basically a loan. When you buy a bond, you are lending money to a government or a company. In return, they promise to pay you interest and return your original money on a set date. So instead of owning part of a company, like with a stock, a bond investor is acting more like a lender. What a bond really is. Think of it like this. You give an issuer money today. The issuer pays you interest over time. At the end of the bond's term, the issuer pays back the original amount you invested. That original amount is called the principal or face value. Example, you buy a bond for $1,000. It pays 5% interest. You receive $50 per year. When the bond matures, you get your $1,000 back. 2. Main parts of a bond. To understand bonds, you need to know these basic terms. Face value, the amount the bond is worth when it matures, usually $1,000 per bond. Coupon rate, the fixed interest rate the bond pays. Example, $1,000 bond with a 4% coupon pays $40 per year. Maturity date, the date the issuer repays the principal. Yield, the actual return an investor earns based on the bond's current price. Issuer, the government or company borrowing the money. 3. Why governments and companies issue bonds? They issue bonds because they want to raise money. Governments issue bonds to fund things like roads, schools, military spending, public programs, national debt obligations. Companies issue bonds to fund things like expansion, equipment acquisitions, new projects, and refinancing old debt. So bonds are a way to borrow from investors instead of borrowing only from banks. Government bonds. Government bonds are issued by national governments, and in many cases, they are considered among the safer types of bonds, especially when issued by financially strong governments. Types of government bonds. Treasury bills, short-term government debt, usually maturing in less than 1 year. Treasury notes, medium-term debt, often maturing in 2 to 10 years. Treasury bonds, long-term debt, often maturing in 20 to 30 years. Municipal bonds, issued by states, cities, or local governments to fund public projects. How government bonds work. If you buy a government bond, you are lending money to the government. In exchange, the government agrees to pay you interest and repay the principal later. Example, you buy a 10-year government bond for $1,000. It pays 4% annually. You receive $40 a year. After 10 years, you get back $1,000. Why people buy government bonds? People often buy government bonds because they want lower risk, steady income, capital preservation, diversification in their portfolio. They are common for retirees and conservative investors. Pros of government bonds: generally safer. Especially with strong national governments, the risk of default is often lower than with companies. Predictable income: most pay interest on a regular schedule. Lower volatility than stocks. Bonds usually move less dramatically than stocks. Useful in uncertain times. Many investors use them for stability. Risks of government bonds. Inflation risk. If inflation rises, your bond income may lose purchasing power. Example, if your bond pays 3%, but inflation is 4%, your real return is negative. Interest rate risk. When interest rates rise, existing bond prices usually fall. Lower returns. Government bonds are often safer, but usually pay less than riskier investments. Credit risk. Though often low for strong governments, some governments can have repayment problems. 5. Corporate bonds. Corporate bonds are issued by companies. When you buy one, you are lending money to that company. The company promises to pay interest and repay your principal at maturity. Because companies are usually riskier than major governments, corporate bonds often pay higher interest rates. Why companies issue bonds? A company may issue bonds to build factories, expand operations, launch new products, buy another company, and manage existing debt. For companies, bonds can be a major source of financing. How corporate bonds work. Example, a company issues a $1,000 bond. Coupon rate is 6%. You earn $60 per year. At maturity, you get your $1,000 back. If the company stays financially healthy, the bond works as promised. If the company struggles, the bond becomes riskier. Pros of corporate bonds: higher yields. Corporate bonds usually pay more than government bonds. Regular income. They often provide predictable interest payments. Portfolio diversification. They can balance stock exposure. Range of risk choices. Investors can choose safer large company bonds or riskier higher yield bonds. Risks of corporate bonds. Default risk. The company may fail to make interest payments or repay principal. Credit risk. If the company's financial condition worsens, the bond may lose value. Interest rate risk. Like government bonds, bond prices usually fall when rates rise. Liquidity risk. Some corporate bonds can be harder to sell quickly. 6. Credit ratings. Bonds are often rated by credit rating agencies. These ratings estimate how likely the issuer is to repay its debt. Investment-grade bonds, higher quality, lower risk, lower yield. Junk bonds or high-yield bonds, lower quality, higher risk, higher yield. A higher interest rate often means the market sees more risk. That is one of the most important rules in bonds. Higher yield usually means higher risk. 7. Government bonds versus corporate bonds. Government bonds usually lower risk, usually lower return, backed by tax revenue or government authority, often used for stability. Corporate bonds usually higher risk, usually higher return. Depend on company profits and financial health, often used for income with more risk. 8. How bond prices move. A lot of beginners think bonds always stay at $1,000 until maturity. That is not true. If you sell a bond before maturity, its price can go up or down. Main reason bond prices move: interest rates. When new bonds are issued at higher rates, older bonds with lower rates become less attractive, so their prices fall. When new bonds are issued at lower rates, older bonds with higher rates become more attractive, so their prices rise. Simple example: you own a bond paying 3%. Now new bonds are being issued paying 5%. Most investors would rather buy the new 5% bond. So if you want to sell your 3% bond, you may need to sell it at a discount. That is why bond prices and interest rates move in opposite directions. 9. Yield versus coupon rate. These are not always the same. Coupon rate, the interest rate based on face value. Yield, the actual return based on what you paid for the bond. Example: face value equals $1,000. Coupon equals 5% annual interest, $50. If you buy the bond for $1,000, your yield is 5%. If you buy it for $900, your yield is higher than 5% because you still receive $50 a year on a lower purchase price. If you buy it for $1,100, your yield is lower than 5%. 10. What happens if a bond issuer defaults? Government bond default. This means the government cannot fully meet its debt obligations. Corporate bond default. This means the company cannot make required payments. If a company goes bankrupt, bondholders usually have a higher claim than stockholders, but they still may not recover all their money. So bonds are usually safer than stocks in a bankruptcy, but they are not risk-free. 11. Secured versus unsecured corporate bonds. Secured bonds backed by specific company assets. Unsecured bonds not backed by specific assets. These rely more on the company's overall creditworthiness. Secured bonds are usually safer than unsecured ones. 12. Callable bonds. Some bonds can be called, meaning the issuer can repay them early. This often happens when interest rates fall and the issuer wants to refinance at a lower rate. This can be a downside for investors because a high-paying bond may be taken away early. 13. Bond funds versus individual bonds. Beginners often invest in bonds through individual bonds. You buy one specific bond and can hold it to maturity. Bond funds, a fund that owns many bonds. Individual bonds, predictable maturity value if held to maturity. More control, less diversification, unless you buy many. Bond funds, instant diversification, easier for beginners, no single maturity date for the whole fund. 14. Why investors use bonds in a portfolio. Investors often use bonds for income, lower volatility, capital preservation, balancing stock risk diversification. A common reason people add bonds is because stocks can be very volatile, while bonds may provide more stability. 15. Are bonds safe? Bonds are often safer than stocks, but not all bonds are equally safe. Safer bonds, strong government bonds, high-quality investment-grade corporate bonds. Riskier bonds, weak government issuers, low-rated corporate bonds, long-term bonds during rising rate periods. So the word bond does not automatically mean safe. 16. Best way for beginners to think about bonds. A simple way to think about bonds is this. Stocks are for ownership and growth. Bonds are for lending and income. Stocks can offer bigger long-term growth, but bonds often offer more stability and predictable payments. That is why many investors use both. 17. Simple final summary. A bond is a loan made by an investor to a government or company. Government bonds, usually safer, lower returns, often used for stability. Corporate bonds, usually higher yields, more risk, depend on the company's financial strength. Key bond risks: interest rate risk, inflation risk, default risk, credit risk. Key bond benefits: regular income diversification, lower volatility than stocks, potential stability in a portfolio. If you learned anything from this video, like, subscribe, and share. Thanks for watching.